why did I have that projection of Bitcoin? It wasn't an emotional projection. It's like, okay, Bitcoin is following very similar past patterns to 2013, 2017.
I would like to see, obviously, Bitcoin's very momentum driven. So now we need to see some price follow through here and get that momentum going.
So we have a contextualized understanding. We can put it within the logarithmic trend and it would extrapolate being about one standard deviation overbought and around those levels, and that would be correct with the trend. I try and get that across, and I never speak in terms of certainties. So why did I have that projection of Bitcoin? It wasn't an emotional projection. It's like, okay, Bitcoin is following very similar past patterns to 2013, 2017. So we have a contextualized understanding. We can put it within the logarithmic trend and it would extrapolate being about one standard deviation overbought and around those levels, and that would be correct with the trend. At that point, a friend of mine tapped me on the shoulder back in 2012 and said, have you looked at Bitcoin? And it was Bitcoin that suddenly it was like, oh, okay, I get this. It's this scarce asset that has properties that are similar to gold, but this blockchain technology means we can record everything. So if the system blows up, you know who owns what.
Was it Dan Moorhead?
No, this was a guy called Emil Woods, who is very much in the background. He was a partner with Chad Cascarilla, who's founded Paxos. Emil's very much in the background, but has been a thought leader in this space and a prolific investor in this space for a very long time. He got, me into it, and then eventually via that, Mark Yusko, Dan Tapiero, all of this. So Emil was our ground zero for all of this.
The grandfather.
Yeah. So that's how I got into it. I then wrote the first macro paper on a valuation for Bitcoin back in 2013, where I said, well, if it is some sort of digital gold, which basically the white paper refers to, and the work around it at the time, I thought, okay, let's have a look at the above ground supply of gold, the known amounts of gold, and back Bitcoin into it, which is basically a very rudimentary stock to flow model.
Mm-hmm.
And I got the valuation of Bitcoin at $1 million with gold at $1,300. So I'm like, okay, it's trading at $200. This is the best risk reward. And I said, assume I'm the idiot, which I always do. Maybe I'm wrong, and I'm 90% wrong. So its valuation is $100,000. It's still the best reward I've ever seen. So that was my story.
How was that received, the valuation?
With a lot of interest. It circulated around Silicon Valley. It went wildfire. People aren't supposed to share my global macro investor reports. They're very expensive and very exclusive. It got shared around a lot because people could now connect a macro framework to this new asset. And so macro people who were open-minded thought, you know what? There's a risk reward here. May not happen, but why would you not? And so that became very interesting.
So you entered in the crypto space by buying Bitcoin in 2013.
Correct.
All right. So speaking of network effects, I know that you have now it's a pretty popular theory regarding the internet growth versus the crypto growth in terms of network effects. And can you elaborate a little on this?
Yeah, this story was interesting to me, how I stumbled into this. I don't really know anything about Metcalfe's law. It was October 2020 when I noticed that when I started saying the chart of Ethereum looks like it's going to outperform Bitcoin, I got immense hatred. I was like, okay, what's this all about? And I started to try and understand, okay, how do we price Bitcoin? How do we think about it? And I stumbled across Metcalfe's law, and it made total sense. I just think of this whole space as essentially behavioral economics. What you're doing is you're creating a network of people and incentivizing them to grow the network. So I understood that, and Metcalfe's law was basically that. And then when I figured out it actually applied to Ethereum in exactly the same way, I then realized it applied to everything in this space in exactly the same way, that it was all just network effects. And that gave me something to hang my hat on, because I could then understand what was driving the market, how to think about valuation, what was a good project, what was a bad project. It was all about network effects. And I even learned to question what people think of as network effects by just stepping back and saying, okay, what drives the network? It's the number of nodes, the number of connections, Now, what happens if you have a network that's very one-sided, which is just the number of nodes? So investors in this case, or token holders. Well, Bitcoin's a bit of that. It's quite one-sided still. But there are protocols there are applications being built and, Lightning Layer and other stuff. But I looked at Doge, which was this meme coin. I thought, I don't really understand this, but millions of people own it. And my thought process was, well, what happens if somebody builds applications on it? Then you're making the network valuable, more valuable. And lo and behold, Mark Cuban saw that too and said, I'll accept it for Dallas Mavs stuff. Yeah, that's a small thing, but it was a meaningful statement that a network can come any way. It can come from amazing applications like Ethereum, or it can come from a loyal ownership base. And Elon Musk then started on the whole process. Now, I don't know whether Doge ends up building true network effects or not, but it's interesting, and I've kept my mind open to what this all means.
And you basically observe that the same network effects that made, let's say, Facebook, Instagram, Twitter very popular can be replicated or are replicated in the crypto space.
Yes, and they have a propensity to move faster, which is why it's outperforming the internet, because you've created alignment of incentives. So with Facebook, you and I could use Facebook, WhatsApp, Instagram, and connect with our friends, grow our businesses, do all of those things. But we didn't directly participate in the network unless we own shares. But in a crypto protocol, you participate in the network too. So you're highly incentivized to grow the network or protect the network. And that makes it super fast adopting, which is why it's the fastest adoption of any technology in all recorded human history.
And how was this theory received?
People didn't want to believe it because they wanted to believe the narrative of Bitcoin or the narrative of Ethereum or the narrative of certain things. So people anchor themselves on particular narratives and they don't like it to be exposed as something somewhat different. The narrative, everybody has a different narrative in the end, but the network represents all of that. So it actually started to resonate. People started to go, oh, I get it now. This is what it is. And I think I probably made Metcalfe's law mainstream for people's understanding of what this was about by sheer determination of telling people, look, this is what it is. It's not just about the uniqueness of a protocol. It's like, do other people perceive it to be unique and can they create applications on it?
I would just like to step back and get your view on the state of the markets right now and stimulus. For someone like me who's been through enough cycles to sort of think they know something about it, this feels very uncomfortable. And it feels as if we're due for the mother of all corrections and we're just in uncharted territories here. I'd love to get your view of the state of play right now.
I've struggled with this as well, right? Because we all knew there's a debt super cycle. We knew there's problems with the financial system, and we all kind of thought the next recession, which was the one we've just had, was going to be a doozy. And we'd probably end up having to continue to see the ongoing mess that we saw in 2008. What happened was actually the reverse. We saw the largest ever recession outside of 1929, 1930. The markets barely paused, rocketed upwards, and basically shook it all off. The governments papered over all insolvency issues and have basically pushed them forward. So many people, will come off government support at some point and they still have accrued debts to pay. So we've got some payback to come. Many companies were given a lifeline. So many companies didn't go bust in the equation, the natural clearing didn't occur. So we've created yet more debt and the equity market is now reflecting something else. And I struggled with that because this was never something I foresaw. I could see the insolvencies. I could see the government trying to help it. I've seen the change in monetary policy blending into fiscal policy, where basically the central banks will backstop as much fiscal stimulus as you want. So what I did is I went back recently and thought, am I thinking about this wrong? Because I understand this crypto world as well now. And I understand the crypto world is all about offsetting the debasement of fiat money. Maybe I'm looking at the markets in the wrong way. So I went back and changed the denominator for the S&P and just changed it to the Fed balance sheet. And when you divide the S&P by the Fed balance sheet, you get something that intuitively feels more real, which is that after 2008, the markets have traded sideways in a kind of up and down cyclical pattern since then. So then I looked at it against all asset prices, and it basically told roughly the same story, is that it is maybe the value of the dollar or fiat currency overall that has declined, that has made it look like the asset prices increased. The only one that showed any difference, two assets. One was the NASDAQ. That because I think there is a secular trend in technology and there is an overvaluation, but even the overvaluation can be accounted for by the monetary stimulus aspect. So you're kind of neutralizing that. The NASDAQ kind of made sense. And the other one was Bitcoin, which made sense because its job was, it was invented for this. And it's going through Metcalfe's law network adoption phase. So we're seeing exponential logarithmic growth as opposed to linear growth. When I look at it that way, it kind of makes sense. And then what I found is, because you and I would look at the equity market and we think this looks nuts. But then when I look at the equity market versus gold, which is another denominator, it looks pretty normal. Or the equity market versus oil, or all of these assets that have this relative valuation, it doesn't look like the equity market's crazy. It's expensive for sure, but not as crazy as it looks in dollar terms. So I'm just trying to think this thing through as maybe I'm thinking the whole thing wrong.
I get very worried about the amount of debt that we're taking on. The Fed's balance sheet, the debt we're issuing, it just all feels uncomfortable for the way I was educated.
So when I speak to the MMT people, they say in this closed economy that if you print your own currency, you can monetize your own debt ad infinitum. So therefore you can run massive deficits and therefore you can use fiscal stimulus as your primary source of stimulation for the economy. What that fails to account for is the value of your currency. So any country, so Japan is probably going to be the first country that does this. They will end up monetizing their entire bond market. Now, what is the outcome for that? Is there no payback? In which case, you might as well tear up the economic textbooks. The payback's going to be the currency collapses because there'll be
Describe
no bond
monetize their debt. What do you mean by that?
So that means the central bank just buys all of the government debt outstanding, puts it on their balance sheet, and then says, we're just going to write it off. It's done. A debt jubilee. That's as old as, it was in the Bible. If they do that, what is the outcome? Well, the currency collapses. Why? Well, if there's no bond market, there's capital that needs a source of returns, and you've just taken out the world's second largest bond market. So the capital goes abroad for yield because there's no yield left. Forces your currency down because you're selling yen and buying dollars or euros or whatever it may be. So I think when you're talking about should equity be rewritten because of the debt, it's not. It's the value of the dollar that's being rewritten, which was exactly the same conversation we were having a second ago, that we've got the denominator wrong. We don't see it. It's the most, we don't get inflation in CPI because we've got technology, demographics, globalization, and all these mega forces. But we're getting asset price inflation because assets are fixed supply instruments, fixed-ish supply instruments. And the dollar is now a variable supply instrument. So obviously, it takes more dollars to buy the same amount of a fixed asset, which is exactly the argument of Bitcoin, which is the purest of all expressions of this. Or even better is art, where there's only one.
More dollars out there makes the dollars worth less, which creates an explosion in asset prices. We've seen an explosion in asset prices. We haven't seen an explosion in inflation. We haven't seen inflation, and we haven't really seen a debasement in the dollar as far as I can tell.
Well, yes, so two great points. The debasement in the dollar is not in the dollar itself. It's in all fiat currencies because the US is not doing this in isolation.
That's right. Yeah.
Europe is doing more. Japan is, as a percentage of GDP, miles more. Switzerland more. The UK, Australia, they're all doing it. So if you look at, I've got a basket of 27 currencies, excluding the dollar, and look at them versus gold, which is the oldest form of money. And basically, since 2008, when all the central banks started quantitative easing, the value of that basket of currencies has fallen 60% against gold.
Mm-hmm.
And that's kind of makes sense to me. But we don't see it in inflation. So that's the other part of your question. Why not? Well, inflation, in how we measure CPI inflation, is actually based around demand.
Mm-hmm.
And the last time we had large demand for goods from people and wages was the 1970s. And that was because there was a bunch of 30-year-olds who hit the labor force, bought their first house, first car, first suit, first home, first everything, which was the baby boomers. There was no offsetting generation for them. They came in with record low asset prices. They bought bonds, they bought equities, they bought everything, and we created structural inflation for a while until they stopped buying goods at the rate of change. That's all changed now, and those guys are all in retirement and going into retirement, so they're net sellers of assets. They don't buy as many assets. At the same time, with the largest population boom ever, the baby boomers, you then just added 89 million millennials into the same workforce because everyone's working longer. So now you've devalued the value of people by 50%, basically.
Mm-hmm.
And then on top of that, you're then getting those people to compete on a global basis with Chinese or Indians. So that devalues wages further. And you've got technology that's snapping at their heels every day saying, I'm going to make you out of a job because I can do this better than you, cheaper than you, which is the old software is eating the world argument. So all of that is going on at the same time. So the net result is, if you look at real wages over the last 40 years, they've barely moved. Basically, nobody's earning any more money than they did in real terms.
Yep.
Most goods, like TVs and jeans and all that stuff, has gone down in price because of globalization and technology. The things you can't produce more of because of globalization and technology happen to be these fixed price assets. They've all exploded. So you've been able, as an average or a median American, you can afford 60% less in terms of housing with your salary than you could if you were. So the 32-year-old millennial now can afford 60% less than the 32-year-old baby boomer at the same point in their career cycle. That's a